In this presentation, we will continue on with our corporation comprehensive problem entering the adjusting journal entry related to supplies. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Remember, we will be entering these into our adjusting journal entry worksheet, and the adjusting journal entries are kind of like special entries that we make at the end of the time period, and they have a different set of rules. So we first want to look through these through the lens of those rules and see if we can figure out which way the journal entry will be going, what accounts will be affected. Then we'll talk more about why we are doing what we are doing. Now I'm going to leave the adjusting journal entry related to insurance, so it looks more like the worksheet if you're going to work through this by hand and use the PDF files and the worksheets to work through this by hand. So we had completed the insurance expense and prepaid insurance, but we're focusing here now on the adjusting journal entry related to supplies. Now we have here the information supplies on hand as of the end of the month is 5,000. All I want to know right now is it's adjusting journal entry related to supplies, and try to use the adjusting journal entry thought process to think through which accounts are affected. We know it's not going to be cash because it's an adjusting journal entry and it's not cash isn't involved. We know we're going to have one account that's going to be a balance sheet account, or more specifically, asset or liability account. So if we look through these for something related to supplies, we see supplies. So that's going to be one account, we would think. And there's going to be one income statement account within the revenue and expenses, the dark blue accounts, related to supplies. And so we would think, how about supplies expense? So those are going to be the two accounts we're going to be using. We know that the expenses down here, like all expense accounts, goes up in the debit direction. So expenses always go up, meaning we pay for supplies. Supplies never pay us. So we also know that supplies is going to increase. So we're going to increase supplies. That means we're going to debit supplies, and if we debit this account, we must be crediting this account. So we know all that. We don't know the dollar amount, like where do we get this 11,000, but we know we're going to debit supplies expense and credit supplies just by knowing it's an adjusting journal entry related to supplies and applying our thought process. So now we want to think, okay, well, how do we get the number we're going to use? It says 5,000 here. We have 11,000 in our journal entry. When we think about supplies, it's going to be similar to us thinking about inventory. So what we want to think about is that we're buying supplies. I think about like computer ink. If we have a pile of computer ink that we're buying for our printer and it's piled up in the corner, when we buy it, what happens, and note for all adjusting entries, we kind of have to know the story, assume what the story is. So if I have a supplies asset on the books, how did that get there? I need to be able to tell my story to myself. Well, what is that? How did that even get there? Well, it must be that we bought inventory, and when we bought it, we credited cash or a payable, and we debited not supplies expense because we had not yet consumed it, but supplies. So whenever we buy supplies, we put in this ink, this computer ink of supplies in the corner, stacking it up, and then at the end of the month, we're going to determine how much we used. How? We're going to count it. So we'll count the supplies. So we have on the books $16,000 worth of supplies. When we count it, there's only 5,000 left in the physical count. Therefore, the difference, 16,000 minus 5,000, is how much we assume we used during the process, and therefore how much we should expense. In other words, how much we need to bring down the 16,000 to get to the 5,000 in order to get to our physical count is 11,000. And what did we do with that? We must have consumed it. That's the assumption. Now note, we could have lost it. Someone could have stole it and stuff like that. But of course, we assume that difference is consumption of the difference. Now that's a little bit simplified of inventory, because obviously when we think about these numbers, they're on the books in terms of dollars, not units. So when we say, well, we bought 16,000 and we counted it and there's only 5,000 left, we're talking $5,000 worth left. We don't count dollars worth, so that would mean we'd have to look at the inventory and then put a dollar amount to it. If they all had the same dollar amount, that's easy, but oftentimes the dollar amount changes over time, and then we have to get into flow assumptions like inventory costing, like first in, first out, last in, first out, average, specific identification. We won't get into that here, But just note that it's a little bit more complicated than just saying we did a physical count, because we have to do a conversion from a physical number, units, to dollars. But from theory, for now, just think that we got $5,000 worth is what we counted to be there, and the 16,000 is what is on the books. The difference is the 11,000 that we need to bring our inventory down by to get to 5,000, our physical count, and we need to expense the 11,000 was consumed. So here's our journal entry. If we post it out then, supplies expense goes from 0 up by 11,000 to 11,000. Supplies the asset goes from 16,000 down by 11,000 to 5,000, our physical count. So if we look at all the journal entries now, we can say we have our 2 journal entries included. So now this journal entry is included in our worksheet. So our total worksheet looks like this so far. This is our unadjusted trial balance, what happened at the end of the normal journal entries throughout the process. Then we had these 2 adjustments that happened, and note we can kind of tie them out. And sometimes we'll even label these by saying we could like put a little A next to this one, a little B next to this one, and say obviously that this is A and A, and this is B and B, just to link them together. And because there's not too many transactions, this little worksheet works very well. In other words, the reason we have a GL and not this little worksheet for all transactions is because if there was a lot of activity, say to the supplies account, then this one line wouldn't tell us much, because there'd be a lot of activity that would make up that line. But if there's only one thing that's affecting the supplies account, then this worksheet is great, because we can tie it, we can see exactly what's happening in this little worksheet. So if we only have like 10 journal entries, as we do in the adjusting process, this worksheet looks great because we can use it to see exactly what's happening from beginning to end and exactly how these journal entries are applying to this worksheet. So if the worksheet the journal entry that we did, of course, was supplies here and this one, bringing the 16 down by 11 to 5,000, and then we brought the supplies here from 0 up by 11 to 11, and then we're just bringing over all the other numbers. And that means that if we started with something in balance, our adjustments are in balance. Debits and credits are in balance on these adjustments. Debits minus the credits equals 0. And that means that our adjusted trial balance has to be in balance. Debits minus the credits equals 0. We know that the expenses went up. That brings net income down. So net income went down again. Net income is 27,000 revenue or credit minus all the expenses, minus all the debits on the income statement. That brings down total equity. Note that that's often the case when we do these adjusting journal entries. It's often bad news for the owner, because it makes us look worse oftentimes. Most of the adjusting journal entries have to do with expenses going up, bringing net income down. There's a couple of them that deal with revenue going up, and we'll look at those, but oftentimes when we do the adjusting process, we end up looking worse because of the adjusting journal entries. But that's the real, that's what we have to do. That's the more accurate picture of what's going on. For more accounting information and accounting courses, visit our website at accountinginstruction.info.